Do you want to build wealth through real estate? But are you giving up because you don't have hundreds of thousands of dollars? The answer is simple. Use crowdfunding. Start real estate investing with a small amount. Why does it work? This slide explains everything. Traditional real estate investing had massive barriers. When purchasing a property directly, the capital required varies significantly depending on the property price and loan terms. For investment properties, down payments tend to be substantial, ranging from tens of thousands to hundreds of thousands of dollars. Bank loan approvals, the burden of property management, tenant disputes. This is the reality that has kept ordinary people away from real estate investing. But that's changed. Online platforms have dramatically lowered those barriers. Invest with a small amount. Products accessible to anyone have emerged. Professionals manage the properties. This is the crowdfunding revolution, a transformation made possible by a decade of technology. Fundrise, RealtyMogul, and CrowdStreet are the leading examples. And this is achievable. Today, research the platforms. Check the latest offering pages from each company to review the terms. This is how your wealth-building strategy expands into real estate. Today, let me show you the concrete blueprint. So how does crowdfunding actually work? It's simple. Many investors pool small amounts of capital to invest in large real estate projects. You can't buy a major commercial building on your own. But when many investors come together, it becomes possible. This is the essence of crowdfunding. Here's the process. First, the platform vets the property. Then, investors contribute whatever amount they choose. Rental income and sale proceeds are distributed in proportion to each investor's stake. But here's a critical warning. Don't over-rely on the platform's due diligence. In 2023, a serious incident occurred on CrowdStreet. Sponsor Nightingale Properties misappropriated approximately $63 million collected from investors. In response, CrowdStreet was forced to implement reforms, including third-party fund management. What does this incident tell us? Platforms conduct due diligence, but they are not infallible. Scrutinizing each deal individually and verifying the presence of third-party fund management is essential. The peace of mind that comes from professional management is real. But the final investment decision must be yours alone. This is the reality of crowdfunding investing. Next, understand the types of investments. Crowdfunding has three primary investment types. Type 1, eREITs, the digital version of a real estate investment trust, automatically diversified across multiple properties. Risk is spread out, making this ideal for beginners. Fundrise is widely recognized as the flagship in this category. Type 2, individual property investments. You choose and invest in a specific apartment complex, commercial facility, or warehouse. There's potential for higher returns, but if that property fails, the risk is also concentrated. As the CrowdStreet incident demonstrated, verifying sponsor credibility is especially critical here. Type 3, debt investments. Think of it as lending money to real estate developers. A contractual interest rate is often quoted, but proceed with caution. In cases of delinquency, loan extensions, or losses, actual yields can shift dramatically. The range also fluctuates with market conditions. Let me add an important note. Minimum investment amounts and participation requirements on each platform vary by product and timing. Today's numbers may not be the same tomorrow. Always verify the latest details on each company's official offering pages and help centers. Choose the type that matches your risk tolerance and goals. That's your starting point. Now, let me be straight about the most important numbers. A 7 to 12% annual return. Is this actually a realistic figure? The answer depends on the conditions. Historically, there have been periods when this range was achievable. But you must face reality. According to Fundrise's official data, the average return across all clients in 2023 was negative 5.15%. The result of a sharp spike in interest rates hitting real estate valuations hard. What does this fact tell us? Real estate crowdfunding can deliver losses in certain years. Returns fluctuate significantly depending on market conditions. There are critical things to watch when looking at return figures. Is it a target, a historical result, a dividend yield, or an IRR? These are all different numbers. Whether fees are deducted before or after also varies by product. Before investing, always review the definitions and risk factors in each deal's disclosure documents. Let me walk you through a calculation. $10,000 invested at a 9% annual rate for 10 years, with distributions reinvested. Before taxes and fees, the 10-year projected value is approximately $23,674. This is a figure that assumes all conditions are met. Real estate crowdfunding is a long-term investment. Don't judge it by a single year's numbers. Let me be direct about the risks. Crowdfunding carries risks fundamentally different from equities. First, liquidity risk. With stocks, you can sell today. As long as the market is open, you can cash out instantly. Real estate crowdfunding is different. Redemption typically takes weeks to months. Here's something even more critical. In the event of a sudden market shift, provisions exist that give platforms the legal authority to completely suspend withdrawals. This is a legal right disclosed in the prospectus. There's a real risk that you won't be able to liquidate your investment, even in an emergency. Next, interest rate and market risk. Since 2022, U.S. policy rates have surged, creating significant headwinds for commercial real estate. Rising refinancing costs, valuation adjustments, cash flow deterioration. This actually happened. The sector gap is particularly severe. U.S. office vacancy rates have reached historic highs as remote work becomes entrenched. Meanwhile, residential, logistics warehouses, and data centers remain relatively resilient. What you're invested in, that's what determines whether you win or lose. Furthermore, what you hold is not the real estate itself. In most cases, it's an interest in a vehicle, such as an SPV or LLC. Protections in the event of platform insolvency depend on the contractual terms in the disclosure documents. So how do you respond? Follow 3 rules. Rule 1. Keep emergency funds separate. 6 months of living expenses must always be kept in a highly liquid account. Rule 2. Limit exposure to 10 to 20% of your investable assets. Balance with equities, bonds, and cash. Rule 3. Verify the sector of your investment target. Office, residential, or logistics. That distinction has a massive impact on returns right now. So how do you choose a platform? Let's compare 3 leading platforms. Fundrise. Known for products with relatively low minimum investments. Primarily eREIT format, with diversification across multiple properties. Products open to all investors are central to their offering, making it well suited for beginners. For fees, don't stop at the management fee. Check the total cost on the official fees and expenses page. RealtyMogul offers both eREITs and individual property investments. Products for all investors are available. Minimum investments and terms vary by product, so checking the official page for the latest information is critical. CrowdStreet, focused on direct investment in individual properties with high transparency. Many deals are targeted at accredited investors. However, as the fund misappropriation incident highlighted, sponsor risk warrants particular vigilance. In addition to platform fees, acquisition and management fees charged by the sponsor apply. Review the prospectus thoroughly for total costs. Here's the most important point of all. Minimum investment amounts, participation requirements, and fees on each platform vary by product and timing. Today's numbers are not guaranteed to be the same tomorrow. Always verify the latest details on each company's official offering pages and help centers. What is an accredited investor? It's the U.S. SEC standard, annual income of $200,000 or more, or net worth of $1 million or more. However, depending on the type of regulation, there are deals where non-accredited investors can participate. Eligibility varies by deal. Always read the qualification requirements on the offering page. Now let's consolidate today's key takeaways. Here's today's summary. First, the barriers to entry have fallen. But proceed with caution. The tens to hundreds of thousands of dollars once required for traditional real estate investing have been dramatically reduced by crowdfunding. But don't over-rely on the platform's due diligence. As the 2023 CrowdStreet fund misappropriation incident shows, scrutinizing each deal and confirming third-party fund management is non-negotiable. Second, returns fluctuate. Face reality. There have been periods of strong historical returns, but 2023 saw an average annual loss exceeding -5%. Always confirm whether a yield figure is a target, a historical result, and whether it's before or after fees. Right now, sector selection matters. Avoid office and prioritize residential, logistics, and data centers. Third, liquidity risk is real. Only invest capital you won't need for years. Provisions exist that allow withdrawals to be completely suspended during sudden market disruptions. The smart move: secure 6 months of emergency funds separately, then limit real estate crowdfunding to 10 to 20% of your investment portfolio. There's real value in adding real estate as a pillar of your portfolio. But can you design that pillar correctly? Share your strategy in the comments. Which sectors are you watching? How are you preparing for liquidity risk? What are your questions? Every insight becomes wisdom for this community. Thanks for investing your time with me today. On this channel, we break down everything from real estate crowdfunding to equities, bonds, and alternative investments, giving you a data-driven, reality-based blueprint to architect your wealth. Not dreams. A precise information-based blueprint is the only path to financial freedom. Subscribe and turn on notifications so you never miss the next insight. See you in the next one.